Hello and welcome to Streetwise Economics Weekly Market Commentary. And today I'm going to be talking about briefly what happened in 2024 in the stock markets, particularly in the US stock markets, and also some updates on what's really happening today in real time. And I will do a bit of technical analysis, but share with you some economic data and what I think in terms of where or how those data points can potentially move the market. And again, I like to start off by saying I'm not an investment advisor. Therefore, whatever I'm going to discuss in this video is purely my experiences, and you should not take it as investment or finance advice. Now, for those who don't know me, my name is Isaac Jonas, and I'm an economist by academic training. I studied at the University of Zimbabwe, where I completed a Bachelor of Science degree in economics, but then decided to immigrate to Canada, where I then completed two master's degrees from the University of British Columbia, namely Master of Food and Resource Economics and Master of Arts in Resources, Environment, and Sustainability. I was also lucky to be one of the first five scholars for the MasterCard Foundation Scholarship, which seeks to educate the next generation of leaders, young leaders from Africa. And over the years, I have started this journey of investing and also now recently trading in the financial markets. And I have learned quite a lot in terms of how the market moves. But of course, there's still a lot more that I don't know and that I'm learning. And that's something that makes this journey particularly exciting because every day I'm waking up and I'm looking forward to some surprises and in the process, generating some income through this. I have said that, my move into creating content and also participating in the stock markets was accidental in a way. I worked in a bank, a Canadian bank, and I've said this story in the past for those who may have seen this. But what fascinated me was that, I wanted to grow my money. And then when I walked into the bank, I was told, have you considered guaranteed investment certificates? And the banker, for me, I asked them, like, how much is that return in a year? I think it was about 2%, considering the inflation here in Canada. So it got me thinking to say, look, if I really want to grow wealth, where can I get at least maybe 6%, 10% return so that I can compound my money? Then the question was, how do I do that? How can I achieve that? And of course, I think banks are very good and I save and sometimes even invest my money with banks. And they are very good player in the economy. And what I learned is that sometimes you go there and you tell them what you want, and they tell you what they think in terms of maybe your age, your risk tolerance, which is good. So I then decided to do self-directed investing. So that means I did do my own investing, but that requires me to stay focused on what's really going on in the markets, but also do my own research because if I screw up, then I'm gonna lose my money. So it kind of keeps me on the toe. But like I said, I do have a bit of background in economics and finance. So that kind of like makes it easier to understand these things. Now, I then also decided to create content. I wrote a book, like you can see, The Intelligent Millennial Investor, and I have another book on trading that I am planning to have published this year. But mostly it's about sharing my experiences. For me, life has been much about learning, making mistakes, but the key thing, like what Morgan Housel, who wrote the popular book, The Psychology of Investors, mentioned, was that it should be good enough for you to make mistakes, right? But as long as, let's say, if you're investing in the market, as long as it is not financially ruinous. Imagine if I have 100,000 invested and I make a mistake, I invest in a stock and it drops to zero. That means I can put myself and my family in a financial disadvantage. But likewise, if I'm able to multiply that, it would be something good. So that's something that I then decided to say, look, I want to create content, share my experiences, not as investment advice, but also just sharing what I'm learning, just like many others I I follow too. Now, um, in 2024, the S&P 500, which is an index that tracks 500 companies that are publicly listed in the United States. And you see that they cover a cross section of sectors, finance, technology, and which has contributed to most of the gains, actually, like over the past, most recent past, and other sectors like real estate. It retained that index, it retained 24%. That means if I had 100,000 invested, at the end of the year, I would have generated, or the market will have given me 24%. But the way that I invest and have exposure to the S&P 500 is that I buy exchange traded funds that track this index. And there are quite a number of them. The NASDAQ that focuses on the technology companies. You know, talking about the Apples, the Teslas, and even the Microsoft, quite a number of them. I think there are almost 100 companies. So there are also ETFs that track them. And there are different sectors that have different indices. So in other words, for me, the way that I look at it, I want to have a broad diversification to say if another sector doesn't perform well, then I'll have some exposure. Now, the interesting thing about what happened last year was that, let's say now I grow the money will have grown by 24%. Now it means if I then generate, let's say, 10% this year, again, that would be 10% of 24%, right? Of 100,000, right? You add it, right? Compound interest. So that would be 10% of now 124,000. That's how compound interest works. So that's a bigger base, right? And then if I grow it by another, let's say 10%. So if I manage to consistently do that, I'll end up having an exponential growth function. That's how compound interest works. And most of the money is just being generated from compound interest. Now, the key question in investing is that how do you know that the market is going to go this way, and how are you going to be able to generate these positive returns consistently? And that's the challenge. That's where the trick is. But I like to look at the history and the macroeconomy to say which sectors do I think will give some returns. And like I have indicated before, I always like to disclaimer that whatever I'm sharing here, is not to be taken as investment advice. So moving on to 2025, the market, the first trading day, that was yesterday, the 2nd of January, the S&P 500 and even the NASDAQ, they dropped, right? So the first day, it was down. But the way that I look at it when I'm investing is I'm looking at the long term, my time horizon, 10, 15, 20 years, right? So I am not really particularly worried about this short-term movement, especially if I'm looking at those sectors such as like the S&P 500, the broad market, right? Because historically it has retained about 10% according to Investopia. But past return does not guarantee the future. But for me, another key question is to balance the risk and the potential. But what I've seen is that a lot of people, they panic when the market drops, and then they sell, then they buy high, they sell low. So in that process, if I have an emergency fund and I can just sit and wait and let the money compound and even adding more money as the market drops. Now, you will see that I'm going to share with you a bit of technical analysis here so that you see this is the market. That's what's happening. You can see that the market has really gone up today if you look at the S&P 500, right? But the Dow Jones also even is up. As you can see now, it's trading. It's open. The market is open. It's up almost 0.8, 1%. But then Nasdaq is almost 2% up, 1.73%, and the S&P is 1.29%. But you see that gold, is down today, but yesterday it was up, right? So this is what happens, and what I've also been saying with my colleague as well here, Blooming Umorin, is that we have observed that the VIX and the equities market, particularly the S&P 500, they go in inverse, right? So in other words, now you see the S&P 500 index, which is on your screen, is going up, right? And this one is going down. Now, NVIDIA has been ripping up, you can see here, and Tesla, but these stocks, they were red yesterday. So what that means is that if I was a trader and I bought some of these shares today, tomorrow I would cash out. But the question is, I don't know if it's gonna go up or not. That's where the trading gets so tricky. Now, you can see here that today, when I woke up, when the market opened, right? I am on Pacific Standard Time, and this is a chart for trading view. For those who don't know, and it is tracking the movement of the market, S&P 500 here. In this case, let me just do the index, right? Not the ETF, which in this case, the SPY that was on your screen, it tracks the S&P 500 index, right? So it mimics that. So you can see here that when the market opened, I'm on Pacific Standard Time. But this is New York time here, right? So when the market opened, right, this was around here, right? And you see that the market just started by just going up, right? And down, up and down. So this is just a minute by minute. So that's what happens. So people make money if you are able to say, okay, at this point, I think it's going to go down, right? And then you make money. So you can see that the market can be a roller coaster. So what I do is I use both technical and fundamental analysis when I'm trading. And I've done a course on my website at www.streetwiseeconomics to go in detail. So this is how the market is trading. Now, what I find interesting is that at the end of the day, each time that I have, focused on just investing in quality individual companies, I've been having good returns because generally these companies, they tend to go up because they are beating earnings, they have cash flows that are going up, and they have services and products that are in demand so much that at the end of the day, if I'm able to get in when they are undervalued, so that means I should have an understanding of how to value companies. And that's what I do. If you want to learn more about that, feel free to reach out to me via www.streetwiseeconomics. And I coach quite a number of people who want to learn about how to invest. Now, another key thing that I've learned is that it is important to understand, especially on my trading, to understand the economic data, the macroeconomy. In other words, if I'm looking at the US, what are the key numbers or published data that's going to move the market? So I'm looking at things like the Federal Open Market Committee, that's if the Fed is signaling to increase interest rates, employment data, and stuff. So you see that this week, these were the data points that came up. You see that in China, there was the manufacturing PMI indicator, the economy. This sector actually, it grew because any number that is greater than 50, it shows that it expanded. But you see that it dropped from the previous, right? Slightly by 0.2%. But you see that also the analysts, they focused at 50.3%. So usually what happens is that even analysts who are people who spend a lot of time trying to, understanding these sectors and projecting into the future, and the actual data, when it comes out different, that's what usually causes market volatility. And of course, there are numerous things that can cause market volatility or the market to move up and down. Now, that's only the equity side of things, right? But there are also bonds, gold, like I showed you. Some people are investing in crypto. I'm not a big, big on crypto. That's a personal decision because I don't understand it. And that's not to say those people who are investing, but it's their money, right? I have a very small position that I just kind of like a speculative bet. Now, I like to invest in the equities market because I spent quite a bit of time trying to understand individual companies and how these companies are doing. Now, as it was holiday on January, right? But the initial job claims in the US, they came up lower than expected, 211,000, and which is a good thing because what that means, if there are less in job claims, it means more people are getting to work, right? And the last time that I checked, there were about 7.1 million, according to investing.com, if my number is correct. 7.1 million people that were looking for work in the US. And of course, the US is a very, a lot of people. And what that means is those people who are actively looking for work, and about 7.1 million were looking for work, right? Now, if I look at the global manufacturing PMI for December, it contracted, right? Slightly, because if this number is less than 50.0, but it was better than, it was slightly lower than last time, right? Because this was the previous 49.7, but analysts had forecasted that it was going to be lower. So it came out better than expected by the analysts. Now, what's the implication? It means that even though it didn't expand overall, right? But it was better than what analysts expected. So sometimes these are the things that can move the market. Now, the ISM manufacturing sector, it also came better than analysts forecasted, but the manufacturing sector in the US, this data was released today, it came better than expected. So that means the manufacturing sector expanded, which is a good thing. So probably these are the things that can possibly cause the market to rally up. There are numerous causes of the markets going up. Now, for next week, these are the major things to keep an eye on, especially the FOMC minutes that are going to be released. Investors like to pay particular attention to them because there are nuances there in terms of the tone. Let's say there's a dot plot or some insights to say what are the Federal Open Market Committee members thinking, and they can really move the market because they are the ones who determine the monetary policy. Either what that means is they can influence the money supply through playing with interest rates or the fund rates, buying or mopping out excess liquidity in the market. So these are the things that I think at the end of the day, because I like these that have three tickers, that they can cause potential volatility. So that means if I'm trading, I can potentially make money. And I got this data from investing.com. It's a very good source for data. Now, in terms of my outlook for 2025, I cannot predict the market, but looking back, just as a student of history, I like to follow Ray Dalio, and he goes in detail in terms of how he sees the past and models the future. Of course, to model that, you need to have an understanding of what's going on, right? But again, still there may be surprises. But what I've seen that 78% of the time, the market, the US equities market, particularly the S&P 500, it has been going up. And the average, like I said, is about 10% per year. Now, what that means is there are some years that have really gone up by so much, but you can see that they are consecutively, the market has returned positive, like for more than 3 years. So the past 2 years, 2023, 2024, it has S&P 500 has returned about 24% per year, right? And this year, nobody really knows. But like I said, I like to balance the risks. So I have a bit of cash to average down on my core positions, and I'm looking at companies that are in different sectors, right, that I believe to possibly go up. I'm thinking of, this is not investment advice, of looking at companies in quantum computing, also in technology, but also specifically looking for companies that I believe to be undervalued, because I like to buy when the stocks are undervalued, because there's this perfect market hypothesis that says that that was started by these professors from University of Chicago, and what they found was that the market tends to um, as long as there is now an opportunity, everyone tends to go there, buy, and by so doing, they bid up the price so much that the market then tends to be in equilibrium, right? That's ideally what tends to happen. So what that means is if people see an opportunity, everybody wants to make money, so they rush into that. Now, having said that, there is also probability. This is just probability, right? That the market can also drop, right? And you can see here by this chart from Piranha Profits. I like to follow Adam Cole. He's a very insightful person, and I like to learn from him as well. And I took this chart from them, and it shows that the data here shows that 22% of the times in the past, since 1951 to 2024, the market has been down 22% of the time. So what does this tell me as a long-term focused investor? Yes, right? Over the long term, if I stay invested in, let's say, the S&P 500, I have a good probability that my money would grow if I just keep on investing in dollar cost investing, right? But I like to stay on a few individual companies that I understand. Now, having said that, I want to thank you guys for being part of this journey. And I hope 2025 is a lot of opportunities. And if you haven't subscribed to this channel or any of my social media handles you can see on the screen, please make sure you can subscribe so that you can catch the latest of what I will be saying in the market. I also have a weekly newsletter that I send out to subscribers, and wherein I share my insights and what I think about what's happening in terms of opportunities, challenges, and some of my trading or investing moves. Now, thank you so much for being with me, and may the markets be with you. Trade and invest wisely, and I'll see you in the next video. Have a fantastic 2025. Bye bye for now.